I used to think I needed 20% down and perfect credit to get approved for a mortgage, but none of that was what actually got me approved. What finally worked had nothing to do with saving more money and everything to do with understanding what lenders really look for. So if you've been trying to get approved, especially with USDA or FHA, or you're just not sure where to start, this video is for you. I'm going to break down the one thing that made the biggest difference for me and how you can use the same strategy to move from not ready to approved. So here's the advice most people get when they're trying to buy a home: save more money. And sure, saving is important, but in my case, and for a lot of people that I work with, saving more wasn't the issue. I had a few $1,000s in the bank, enough to cover some closing costs or work with down payment assistance, but I still kept getting stuck. The real problem? My debt to income ratio, and to a lesser degree, my credit score. See, lenders weren't just looking at how much money I had saved, they were looking at how much money I owed, and how much of my monthly income was already tied up in debt. That number, your DTI, is one of the biggest factors in whether you get approved. I remember getting pre-qualified thinking I was finally good to go, and then the lender came back and said, "Your DTI is just too high." I was crushed. I had money saved, I'd done the research, and it still wasn't enough. So what exactly is debt to income ratio? It's just a way for lenders to measure how much of your monthly income is going toward debt payment. Things like car loans, credit cards, student loans, and any other monthly obligations you have. Let's say you make $4,000 a month and you're paying $1,000 total toward debts. That's a 25% DTI. Once you add in your future mortgage payment, taxes, insurance, and all of that, lenders want the total number to stay within a certain range, usually under 43% for FHA and under 41% for USDA, though exceptions do exist if you have compensating factors. So even if you have $5,000 saved, if your DTI is too high, you could still get denied. That was my situation. I had enough saved to make something work, but I was barely making a dent in my debt, and lenders weren't comfortable approving me. That's when I realized I didn't need to save more, I needed to lower my debt to income ratio. You can go to my website at workwithdang.com for free resources like a quick start home buying guide and a home buyer's course. I can help you find a real estate agent in your area. There's more information on my website. I make videos like this every week. Subscribe if you haven't already. So instead of trying to save another $5,000 for a down payment, I used what I already had to pay down debt. I looked at my credit cards and asked what monthly payment is dragging down my DTI the most. In my case, it was a couple of credit cards with balances that weren't huge, but the minimum payments were high enough to hurt me on paper, so I paid those off first. The difference it made was almost immediate. I went from being just outside the approval range to solidly within it. And I didn't need to earn more money, wait for a raise, or take on a second job. I just used some of the money I already had in a smarter way. Now, if you're trying to qualify for a USDA loan where it's 0% down, or an FHA loan where it's 3.5% down, this strategy can be a game changer because those programs already help with the down payment side. So if you've got $3,000 or $5,000 saved, using some of that to pay off credit card debt or a car loan might give you way more leverage than saving a few more grand for closing costs. And once my DTI was in a better place, I could actually use programs like USDA or down payment assistance to help cover the rest, because at that point, I finally qualified. Of course, I didn't wipe out my entire savings, but I realized using some of it strategically could move me forward instead of just sitting there while I stayed stuck. Now let's talk credit. Your credit score still matters, especially with FHA and USDA loans. You need at least a 580 for FHA and usually a 640 for USDA to get automated approval. USDA doesn't have an official credit score that they look for. There are also lender overlays. For example, just because FHA allows for a 580 doesn't mean all lenders will accept a 580. They have their own requirements. So while your DTI is a huge factor, your credit still needs to be workable. If your score's on the edge and you don't necessarily need to raise it 100 points, even a small bump can help. Things like paying off small balances, removing any errors from your credit report, asking for a credit line increase, utility or streaming payment history. But don't get stuck obsessing over a perfect score. If your DTI is high and your credit is borderline, paying off debt can improve both at the same time. So what are lenders really looking for? It's not perfection, it's stability. They want to see that you've got steady income, manageable monthly expenses, a decent credit history, and a budget that works within your future mortgage payment. They're not just looking at your savings account, they're asking, can this person reliably make their payment every month? So when I focused on lowering my DTI and improving my credit just enough, everything changed. That's when I got pre-approved. That's when the doors started to open. And honestly, I wish someone would have told me that sooner. If I had to do it again, if I were starting today, here's the plan that I'd follow. First, I'd look at my current debts. What's hurting my DTI the most? Can I pay any of it off with the money I already have? Second, I'd pull my full credit report, not just my score, and look for mistakes or late payments that I can clean up. Third, I'd run the numbers with a lender who works with first-time homebuyers, especially FHA or USDA. I'd ask them what's stopping me from getting approved today, and what can I do to change that in the next 30 or 60 days. Fourth, I'd stop obsessing over saving for a huge down payment if I qualify for a loan that doesn't need one. I'd use that money to make my finances look better on paper, because that's what actually gets you approved. Now, a couple of things to keep in mind. Starting with low or no down payment means you'll have less equity in the home at first. And in competitive markets, sellers sometimes prefer conventional buyers with more money down. But if getting approved has been your biggest hurdle, this strategy might get you in the game, and that's what opens the door to everything else. So yes, the one thing that helped me finally get approved for a mortgage, it wasn't hitting some magical savings number, it wasn't fixing every little thing on my credit, it was understanding that lenders care most about whether you can afford the monthly payment and making my file reflect that. If you're trying to buy in 2025, especially with USDA or FHA, don't just save for the sake of saving. Look at your whole financial picture. Ask what's holding you back and focus your energy there. That's what worked for me, and I think it can work for you too. This isn't about taking shortcuts. It's about focusing on what lenders actually care about and using your money where it makes the biggest difference. Check out this video to learn how much you should actually save before buying a home. Please like, comment, and subscribe. It motivates me to make more videos.